Well, thank you very much. It's a pleasure to be with you this evening. I very much wish that I could be there in person. Unfortunately, that wasn't possible, but I appreciate Jerry and the others up there to make it possible to do this presentation remotely. As Jerry mentioned, I run a business called Resources for Development Consulting with a simple but challenging mandate, and that is to help resource-rich countries get a fair share of revenue from oil, gas, and mining projects. And I'm going to tell you over the next 40 minutes or so about the ways in which we try to do that. We work in more than in Africa, Asia, and Latin America. So our focus really is developing countries. But I've been struck in recent years at the parallels between the work that we do overseas and the challenges of securing a fair share back here at home in Canada, and particularly in the north. So I'm delighted to have the opportunity to say at the outset, though, that I have not done detailed economic analysis of the fiscal regime of the Northwest Territories. I'm not a specialist in any way on the challenges of figuring out the balance between revenues that stay in the north and revenues that get paid to the federal government. I should say also that there's an excellent study by a colleague of mine, Andrew Bauer, did a piece for the government of the Northwest Territories that's part of the debate around your discussions on new legislation. It's an excellent study, and I'll refer to that a couple of times over the course of the presentation. This is probably the most important slide of the whole night. If a company were here to talk about the benefits that a government and its people should secure from an extractive sector project, mining oil and gas, they'd probably put up a list something like the one. They'd talk about the benefits of economic growth, of employment, infrastructure, community investment, and finally taxes. I don't have time to go into these in detail, but let me give you a really quick assessment of the first four before explaining why. Question that extractive sector projects can generate significant economic growth, but much of that in our experience in countries around the world are really numbers that don't mean a lot to the people living in the jurisdiction. I could give you examples of many countries in the world that have among the highest growth rates in the world, and poverty is still rampant, education is weak, and the rest. So GDP growth doesn't necessarily translate into real meaningful change for people on the ground. Employment, this is a tricky one, because there's no question that jobs are important, and they're particularly important in the Canadian North and in the NWT. But we talk about extractive sector projects as capital-intensive projects, and that means that there are very few jobs. In fact, if we compare it to other sectors like manufacturing, oil and gas and mining generate 1/10, maybe 1/20th the number of jobs of a dollar of investment in those other sectors. The government of Ontario did a detailed study of this some years ago, and they concluded that $1 billion of investment in the mining sector generates 5,000 direct, indirect, and induced jobs. That means the person that works at the mine, the person that fixes the truck for the person that works at the mine, and the school teacher who teaches the kids of the mechanic who fixes the truck that works in the mine. 5,000 jobs for $1 billion. It's not much. By saying this, I'm not saying that it isn't important to try and extract every high quality job you can. I'm just talking about the relative benefits that a jurisdiction secures from extractive sector. Infrastructure is another, in your experience in the North, I think you know that in many cases the infrastructure is actually built by the government, not by the company. When it's built by the company, it's designed to get resources out of the ground and get them to market. Sometimes there are dual use, mixed use spin-offs, but for the most part, it's very context specific. And finally, community investment. There's no doubt that companies put some money into local communities. The high water mark for this is usually about 1% of pre-tax profits. So while sometimes these initiatives can be important and make a valuable contribution, they really operate at the margins. So that leaves us with royalties and taxes, and I'm going to say quite a bit more about this in a few minutes, but basically a well-designed fiscal regime should secure you between 40, 50%, maybe 60% of pre-tax profits. So you can see that taxes kind of overwhelm in many respects the other contributions that can be made, or at least should overwhelm those. You don't find many companies that say this, but I'm going to show you a quote here from one that does. It's the chairman of Tullow Oil. It's an independent oil company based out of the UK. And he was asked why the company took seriously the idea of transparency of revenue payments. Why should a company care to let citizens know how much they were paying the government? And he says, like every company, we have a certain budget for corporate social responsibility. We create some jobs, we buy goods and services, and here is the kicker. But the biggest contribution we make by far is the tax that we pay. I would really argue that in the case of extractives, the jurisdiction is selling a natural resource, a non-renewable natural resource, and that makes it different from other businesses, and you should expect more. So what we've tried to do as a company is develop a comprehensive assessment to understand how governments should get tax revenue out of extractives. We find that there are many different ways in which revenue is lost, but the pathways are not unlimited. And that means that there's a certain set of patterns that can be uncovered and a certain set of kind of opportunities that can be put forward to governments. It's important to have a comprehensive framework here, though, because in many respects, there's a focus in one area to the detriment of others. And here we often talk about the balloon theory. You grab one part of the balloon and it bubbles out on the other side. So without a comprehensive approach to revenues, there's a risk that revenues that you try to gain in one area will simply be lost in another. And finally, it's really important to talk about projects specifically rather than sectors. Commodities are different, the companies that operate them are different, and it generates different kinds of risks. So the publication that I'm basing the presentation on tonight is called Many Ways to Lose a Billion: How Governments Fail to Secure a Share of Natural Resource Wealth. And what we've tried to do in this case is to give this kind of systematic framework. And I'm going to spend a little bit of time in my talk working through the table that you see in front of you now, focusing first on negotiating a good deal, getting the tax rates right, and then secondly on securing what's called the tax base, or the amount of money against which taxes are assessed. Let me say before I turn to that, though, that the value of this analysis, I believe, is not only in the framework that it sets out and some of the guidance it gives on how to secure revenues. It's also, I think, the best collection of real-world case studies that's ever been put down in one place. And this is really important because in many cases, companies will say that this doesn't happen, or they'll say that it's other companies, it's not us. I launched this presentation in London in December, and a representative of a major mining company was there. And after I'd done my presentation, he said, "Boy, your examples, they're really dated." In fact, some of them come from last year or 2 years ago. But it's interesting because until you have a collection of real-world case studies, they say that it doesn't happen. Once you see that there are real-world case studies, then the best they can say is, well, it used to happen and it happens less now. And it's really important to recognize that the examples that I'm going to draw on are not fly-by-night companies. They're not small, dodgy companies. They're world-class mining and oil and gas companies who simply explore the various mechanisms that they have so that their chief financial officer can do his job. And his job is to give as great a return to his shareholders as he possibly can. And that makes it a real challenge because the job of your representatives and government officials is to do exactly the same thing. But in this case, on behalf of citizens. And in fact, frequently when I present overseas, I say that I'm an investor analyst. It's just in my case, the investors are the true owners of the resource, and that's the citizens of the jurisdictions where I work. 3 examples really quickly just to start us off. They're at the bottom here. The first one is Alaska. For over a 20-year period from the late 1970s to the late 1990s, $1 in every 5 that the government of Alaska secured from oil was secured through litigation. They went to court in order to get their share. They spent $250 million in litigation to get $2.5 billion in unpaid tax. Cameco is a Canadian uranium mining company in Saskatchewan. In the late 1990s, they signed a 17-year sales agreement with a subsidiary of their own company based in Switzerland at a very low price, and paid taxes on that low sale price for almost a decade. The Canadian Revenue Agency is going after them now for 2.5 billion Canadian dollars in unpaid tax, arguing that no independent company would have ever made that sales agreement. And finally, Chevron. And this is a case in Australia. In this particular case, Chevron in Delaware, a subsidiary, is lending money to Chevron in Australia in order to develop liquid natural gas. And the company in Delaware raises that money for 1.9% interest, but they lend to their partner company for 8.9% interest. And in fact, it's just a massive tax dodge. And it was the most complicated transfer pricing case in Australian history, and the Australian government prevailed. Billions of dollars, again, were at stake. So those are just a couple of examples how the challenges of securing a fair share are not simple, and countries and jurisdictions that are strong and have good capacity struggle to get their fair share. So let me start by talking then about this first category, the tax breaks, the tax rates. Essentially, we're talking about the deal that you strike. And again, what you're doing is you're selling a non-renewable resource. You get one shot at selling it. And the question is, what's the deal that you're making to a private company? Of course, the company itself needs to make money, and they need to be convinced to invest. So it's got to be a sharing of revenues. The question is, does the government get a fair share? I'm going to go through this reasonably quickly. Basically, there are two kinds of ways in which you can tax an extractive sector project. You can tax production, or you can tax profit. Traditionally, production-based taxes have often been called royalties. Often they're based on a sale value of production. Sometimes, like in the NWT, they're based on some more profit-sensitive measure where they allow costs to be taken into account. And there are risks with that, and I'll come to those risks in the second part of the talk. Generally, there's been a trend towards profit-based taxes. These are more favorable for a company because you're only taking money in cases where they're making money. But I would say that profit-based taxes are also much more vulnerable to tax minimization measures by companies. And again, I'll explain that a bit more in detail. So it's really important to recognize when you're talking about the terms of the deal that it's not just the percentages, a 10% royalty, a 25% corporate income tax. You also need to know what the tax base will be. 10% of what? 25% of what? Of course, we all know the basic math that 10% of zero is zero. So it's really important to know what the revenue base will be that the taxes will ultimately be assessed against. Now I'm going to talk for just a little bit about how you assess different deals, because I think this is really important in the context of the debate that's happening in the NWT. And I'm going to talk about 4 different measures: government take, the timing of revenues, a concept of progressivity, and finally, ease of administration. The last one's probably the most obvious or easiest one for everyone to intuitively understand. But let's start with government take. Government take is a measure of the amount of revenue that goes to the government compared to the company over the life cycle of the project after costs have been taken into account. Okay, so it's a metric that covers the whole project, the whole life cycle, and it's after cost. Basically, how does the divisible revenue that remains after costs get split? And I'm showing you a graphic here that was prepared by NRCan in 2012. Okay, and in this particular study, they were trying to convince the mining sector that Canada is a good place to invest. We're a very favorable place to do mining exploration and get involved in the mining sector. Of course, the flip side of that is being a very generous jurisdiction means you don't necessarily generate very much revenue. And you'll see here quite clearly that the NWT highlighted in orange sits definitely on the low half. You'll see most Canadian provinces are there with them. Same with some US states, Nevada and Alaska. at the bottom, and you'll see developing countries, many of which I work in, sitting on the other side, expecting a much higher percentage over the life cycle of the project. And I must say that I find this shocking. I do some work with the Canadian government as well, helping countries overseas. And we always encourage them to ask for a much larger share when we go abroad than we ask for at home. I'm not sure that I understand why that is. I think it's almost a cultural dynamic where we've come to accept that jobs and some of the other spin-off benefits are where we should be looking rather than looking at revenues. But in my view, that flies in the face of all the evidence from around the world. So in this slide, I've basically highlighted the band where the International Monetary Fund, they do a lot of work with countries around the world. They've probably worked in maybe 80 countries around the world. And in that analysis, they've come to the conclusion that in the mining sector, you should be expecting maybe between 40 and 60% of government take. And that is shown here in the green band. And you'll see countries like Mongolia, South Africa, Tanzania, Peru are all in that area, Indonesia as well. And you'll see, I think quite shockingly, that Canadian provinces are a long way away from that. Let's just say at this stage that you will never get more than you ask for. You can definitely end up getting less than you ask for, and I'm going to talk about that in some detail, but you can never get more than you ask for. And I think it's quite clear that the NWT and Canadian provinces and territories are simply asking for too little. Okay, second, there's a question of the timing of government revenue. And this can be really important in some jurisdictions. I don't have a strong view in the case of the Northwest Territories. I think some jurisdictions that are wealthier, certainly countries like Norway, choose to accept more revenue that comes much later in the life cycle. So maybe it comes in year 15, year 20, year 25. Norway's a rich country, they can afford to make that choice. In many of the countries I work in, there's a real priority to get money early. And that requires different mix of fiscal instruments, a different approach to taxation, essentially to take a bit of a higher share in the early years, maybe a bit of a lower share in the later years, but it kind of evens out over the life cycle of the project. Now, the third element here is maybe a little bit more complicated, and it's called progressivity. Essentially, there's a view that I share that if a project generates what we call windfall profits, a higher proportion, that is the government take, should be higher in those years when windfall profits are coming in than it is under a normal time. The idea here basically is that the company hasn't done anything new or different in order to generate those additional profits, and therefore they should certainly benefit from upswings in commodity prices, but a significant additional proportion should go to the government. I always like the phrase windfall profits here. Most people don't know where the term came from. Came from people who used to do logging in Scandinavia. And when a big wind came through and it knocked down all the trees, their job was done. And they would get paid for the trees that were on the ground, even though they didn't do any chopping. So it's kind of the concept. If there are additional profits that aren't there through any additional effort of the company, the government should get a larger share. Sorry, before turning to the next one, I'll just conclude on that last point about ease of administration. The best set of taxes and the perfect mix and the one that works for all projects is of almost no use if the tax authorities can't effectively enforce it. And in many cases, we see fiscal regimes that are incredibly complicated, very hard to administer, that don't necessarily generate good revenues. So there's a strong bias in our work towards simplicity. And I must say the work by Andrew Bauer that I mentioned earlier and the analysis, the quick analysis that I've done of taxation in Canada generally and in the NWT specifically suggests that it's an incredibly complicated fiscal regime, which creates lots of opportunities for companies to play on the margins, and it also makes it very difficult to administer them efficiently. Okay, so that's the deal that gets secured. I'm going to spend only a couple of minutes on the next point, which is something called treaty shopping. It's much more relevant to the CRA in Ottawa than it is to the people of the NWT, but it's important to recognize that often what happens after companies figure out the deal that they've got, they then go and create subsidiaries in third jurisdictions that give them tax benefits. Okay, so there are taxes on capital gains, and there are withholding taxes on things like interest payments and dividend payments and sometimes technical service fees. And when those payments leave the country, a tax is made, because once the money leaves the country, of course, it can never be taxed again. I'm going to give you only one example here. It's a Canadian example. There's a fascinating Mongolia one that I would normally do for different audiences. But the Canadian one is, it relates to Voisey's Bay, the iron mine in Newfoundland. And there was a company called MIL Investments that held a significant stake in that project. And originally they were incorporated in the Cayman Islands, but they moved to Luxembourg. And they then sold the asset that they held, the stake that they held for 425 million Canadian dollars. And normally there would have been a capital gains tax made on that. Basically, they have made income and they would pay a tax. But there's a double tax treaty with Luxembourg, like Canada has with a dozen or 20 other countries, which meant that they paid no tax at all. Okay, so this is an example, and I put it out partly because it's relevant generally to generating extractive sector revenues, and partly because it's a very good example of how corporations structure themselves in order to take advantage of tax benefits, let's say, or tax loopholes if you want to be a little less charitable. And of course, you've heard all the stories of Amazon and Apple and other companies not paying tax or paying almost none by the way they set up their corporations. The same thing is true of extractive sector companies. And it's one of the reasons why you need to be very careful in analyzing the structure of the company itself. So one of the first things we do when we start a project is we map the subsidiaries and we know where all of them are. So we have ideas about what kinds of tax minimization strategies might be being adopted. Okay, so now we shift from theory to practice. One of the real challenges is that in many cases, the fiscal regime, that is the mix of taxes, looks really good on paper. It just doesn't generate much revenue in practice. Actual receipts often fall far short of expectations. And of course, sometimes this is because of cost overruns in the development of the project or commodity price slumps. But in many, many cases, it's actually because companies are very effective at minimizing the taxes that they pay. And what often happens in these cases is that the government decides to try to change the fiscal terms. And Zambia, one of the world's largest copper producers, is a great example of this, where they've radically changed the fiscal terms 5 or 6 times in the last 10 years, struggling to get real revenue from the sector, when the problem wasn't the tax rates at all, it was the tax base. So there are 2 ways in which the tax base can be at risk. The first one is companies can underreport the revenues that the project makes. And revenues aren't complicated in the extractive sector. You're producing a certain commodity and you're selling it at a certain price. Production times price basically gets you gross revenue on which taxes are assessed. Okay? But there are risks to both underreporting production volumes or the quality of that production, and also to underreporting sale price. The Alaska example that I mentioned at the start, there were many different techniques that were used to minimize tax, but one of them was that they sent one cargo of oil to a particular buyer. They got a cut rate price, and they used that price for all of the rest of the tax calculations for the rest of the year. The person who was responsible for that ended up in court in Los Angeles, and when he was asked why he did it, he said, and I quote, "because he wanted his pension." It was just a normal practice of underreporting revenue. Does it constitute tax fraud? In that case, it did. Companies have ways of reducing the value of the commodity that they report. The other example that I gave you earlier, Cameco. So they signed this long-term sales contract to sell uranium at $11 a pound. And there are lots of market surveys that are saying that the price of uranium is going to be going up. No independent company, the government of Canada argues, would have ever signed that contract. But of course, over those next years, they were paying tax on uranium at $11 a pound, rather than say at the height when it was $70 a pound. So you have to make sure that the revenues that the project generates are accurately reported. And how do you do that? Well, you monitor the volume and value of production, and you, to the degree possible, use international reference prices. So the London Metals Exchange, for example. And to flip back a bit to the idea of production-based taxes, we argue with the jurisdictions that we work with that they should not only use international benchmark prices, but they shouldn't allow any deductions in the calculation of a royalty. As soon as you put costs into the mix, and I'm going to get to that in a second, you create real vulnerabilities. So if you monitor volume and value of production, and by this I do not mean having a person sitting there weighing and counting everything. Companies self-report. They have to produce detailed reports that they submit, and you use a risk-based approach to auditing to make sure that those reports are accurate. And then secondly, using reference prices and international benchmarks. So that's the first way that the tax base can be eroded. And this is the phrase some of you may have followed some of the work that's being done at the OECD, goes under this strange name called BEPS, which stands for Base Erosion and Profit Shifting. But globally, countries are scared of the revenue loss that comes from base erosion and profit shifting. And in this presentation, second part of the presentation, I'm really showing you some of the pathways that are specifically relevant to mining and oil and gas projects. So revenues can be underreported or costs can be overreported, okay? In some cases, this is just duplicate invoices, or in some countries I work in, even false invoices for work that never existed. In some cases, costs are misallocated. So they're technically a capital cost, but they're allocated as an operating cost and no one catches it. In some cases, companies provide the goods and services to themselves. So this is very much like Cameco purchasing its own commodity. In some cases, companies will provide the drilling services or the technical services or the insurance or the marketing or other elements. And when they do, it's not easy to tell whether they're operating on a fair market value or whether they're inflating those costs. And if they inflate those costs, of course, the knock-on effect is that revenues go down. And I've pulled debt financing out as a specific category because in many jurisdictions where we work, this is a huge risk. Companies use a very high level of debt to get projects going. In most cases, they lend the money to themselves, and in some cases, they lend money at very high rates. I gave you the Chevron example where they were raising the money at 1.9 and lending to themselves at 8.9. We see cases where companies are lending to themselves at 10, 12, even more. That can strip the profits out of a project very easily. So what do you do about this? Well, the first one comes back to the concept of simplicity. You close loopholes in the tax law. That's easier said than done, and particularly in a jurisdiction like Canada and the NWT, where the history of the sector means that the tax laws are complex and convoluted. In many jurisdictions where I work, the laws were written 5, 10, 15 years ago. They started almost with a blank slate, and they created things that are reasonably clean and neat. Whereas in Canada, it's kind of one piece stacked on another, stacked on another. It gets complicated. So simplifying the tax law and then risk-based monitoring and auditing is absolutely crucial. The graphic that I'm showing you here is obviously completely fictional, but it's based on real-world experiences. And I'm trying to illustrate here how the two techniques together can ultimately reduce or to almost zero the revenues that companies pay to governments. So in this case, we have a project, a hypothetical project that generates $100 million in a year from production after sale. In every case in this scenario, the real project costs, that is how much it costs to dig the stuff out of the ground and get it to market, are $60 million. And that, in the first scenario, leaves a taxable income of $40 million. This is the tax base, okay? $40 million. And in the second scenario, I've suggested that the company in various ways has inflated the costs. And so rather than the reported costs being 60 million, they become 80 million. And that leaves a taxable income of 20 million, and you can see immediately what happens to your corporate income tax. Now, in the third scenario, project costs are 60 million, but $20 million of the revenue is hidden. It's hidden because the company underreported the revenues, because they sold to themselves, because they didn't use an international benchmark price. And so once again, we have only $20 million of taxable income. And of course, the fourth scenario is the really worrying one. And this is a case where the combination of inflated costs and hidden income mean that there's no taxable income at all. And the really worrying scenario is the fifth scenario, because I've given you just a one-year snapshot here. But if a company has been doing this year after year after year, you can end up in a situation where companies may not pay profit-based taxes ever. Now, I want to give you three quick examples, countries where I work, because I think they're illustrative of the challenges. And again, I mean, it would be much better at this stage if I was to turn to detailed analysis of projects in the NWT, and unfortunately, at this stage, I can't do that. But I think that you'll find these three examples to be illustrative. We've got one bad news example and two good news examples. So the Tanzania case. There are 6 large-scale gold mines in Tanzania that came on stream in the early 2000s. Okay. Some of you who read the mining press will probably have come across a few of these. Acacia, a mining company out of the UK, majority owned by Barrick, has been in the midst of a major controversy around its mines in Tanzania. And the controversy centers around exactly these issues, whether the government was getting a fair share. Now we look at the deal, and we're looking at kind of what we call the headline terms, the tax rates, a 3% royalty and a 30% corporate income tax. It sounds like you're kind of in the ballpark. The royalty, however, allowed costs to be deducted, and so it wasn't really 3%. And we come across this in many, many cases where government officials come to us and they're trying to figure out the calculations of how a 5% royalty ends up becoming a 2.2% royalty. In the case of gold, it's not quite as susceptible to tax minimization strategies as other commodities, but nonetheless, it doesn't turn out to be a real 3% royalty. There's a capital development uplift in this particular case, and I won't go into the details, but it essentially allows the companies to claim much greater costs than what they actually spend. And finally, the challenge of debt financing that we saw in the Chevron case was rife in the case of these mines. The one mine in particular at the center of the controversy in Tanzania, the Barrick negotiations, Bulyanhulu is the name of the mine. It's been producing for 16 years, and it's never paid profit-based tax. Never. So what are the results of these 6 mines? Well, 16 years of production generated $20 billion worth of exports. And of that, the government got $1 billion in royalties and corporate tax. Okay? The Tanzania case is not the good news story. Let's look at the Dominican Republic. Pueblo Viejo is the largest gold mine in the Americas and the second largest gold mine in the world. It's also a Barrick mine, 60% owned by Barrick and 40% owned by Goldcorp. So both Canadian companies. I won't go into the specifics of the deal, but there was an agreement put in place in 2009. It was done at a time right after the global financial crisis. Gold prices were relatively low, and the government offered very generous terms. In 2013, just as the mine came on stream, the government called for a renegotiation. Gold prices at the time were about $1,700 an ounce, near an all-time high. So the government disallowed some costs, reduced some tax incentives, and put in place minimum tax over the first 4 years of the project. And you remember I said government take, timing, progressivity. The Dominican Republic story is really one about timing. It's about moving revenues that probably would have come much later in the project up into the early years. And look at the difference here compared to the Tanzania case. Here in 4 years of production, rather than 16, and 5.2 billion in exports rather than 20 billion in exports, and the government's made more than $1 billion in government revenue. a pretty good news story. Of course, the company would argue that having them invest under one set of terms and then changing the terms was quite unfair. I have some sympathy with that. I wish that they'd negotiated a better deal in 2009 and hadn't had to go back in 2013. Nonetheless, it's a good example, I think, of a government taking an assertive position to defend its revenue interests. And finally, I want to talk for just a minute about Botswana. And I picked this example partly because it's diamonds, but also because it's a great example of a country that has taken its natural resource wealth, the wealth that sits under the ground, and turned it into human wealth, into health and education, into poverty reduction. So the original deal in this case was struck in 1969 with De Beers. It was a joint venture. The government held a 15% stake in the project. There were quite generous terms. They were excited to do some exploration. Of course, they found the richest diamond fields in the world. And the government of Botswana was concerned that they would never get a fair share. And they were right under the original terms. So they renegotiated. They asked for a 50% stake in the project, basically said they would shut down the operation if fair terms weren't agreed. Retrospectively, now De Beers talks about this as an amazing project. They don't talk about it as if the government ripped them off. They both talk about it as an incredible success. I won't go into the specific details, but basically, Botswana has built a country on diamonds. 50 years of growth. They have had among the highest growth rates in the world consistently over 50 years, based largely on diamonds. It generates a third of overall government revenue and $17 billion in money. And as I say, they have used it and invested it in health and in education. One of the things I haven't talked about tonight, it's a major challenge, is not only collecting the money, but then spending it well. Spending it well is hard, and Botswana is a great example where that's really been done. Okay, last two slides. Thanks very much for bearing with me. I know it's not always easy to listen to a long lecture, and particularly when the person's not actually in the room. Two slides, my big picture conclusions. First, the terms of the deal. First of all, there's a real challenge in securing inward investment and generating revenue. In many of the countries that I work in, there's huge excitement in attracting investment, and often very little attention given to whether that investment will really yield much government revenue. In some cases, this is because one ministry is responsible for the resource and a very different ministry is responsible for the tax. I argue that you have to find the balance between these two, and I'm not suggesting for a minute that's an easy balance to strike, but as you're thinking about that balance, it's important to consider the medium and long-term revenue implications, not just getting the operation going. A second point, you've got to look at the fiscal terms, the tax terms as a package. You can't isolate one piece from another. In many places we work, people want to raise the royalty rate, where the real problem is tax-based erosion, meaning no profit-based taxes. So you have to look at these as a package rather than as a sort of cherry-picking one particular term or another. Third point here is you have to benchmark against the competition. The graphic that I showed from NRCan at the start was an attempt by NRCan to do exactly that. They were showing that Canada is an incredibly attractive place to invest. I would say that they're kind of showing at the same time that it's too attractive a place to invest. Ultimately, investors come because of the resource, and you can't make it prohibitively expensive for them to be there, but you can ask for a fair share. Keep the terms simple and enforceable. Simplicity is so important, and it's so rarely done. In most places we work, one tax is added on to another and another. In Canada, there are all kinds of incentives and deductions. Makes it very complicated to administer. And in most cases, they're unnecessary. So to the degree you're looking at revisiting these issues, and I know, of course, the NWT can't do it on their own. There's federal government dimensions to this, but simplicity is so important. And then finally, watch the fine print and the loopholes. And that's a nice segue to my concluding points on protecting the tax base. I was talking to an oil and gas lawyer who I do some work with a couple of months ago, and I was talking about exactly these issues. And I said, how do they do it in joint ventures? Because when multiple companies operate or are part of a same project, they're fighting over the same dollar, right? We're not in a win-win situation here. When there's a dollar to be split between companies, a dollar that goes to one is a dollar that doesn't go to the other, okay? And he says, well, he says the companies all know the loopholes and they audit each other like crazy. He says the governments that he works with, he says they don't know the loopholes and they don't audit. That's a really simplistic approach, but I think there's a lot of truth in it. Routine and independent monitoring and auditing is absolutely important. You got to do this at the level of an individual project. You should develop sophisticated risk assessment methodologies based on the commodity. Some commodities have vulnerabilities in particular places. Other commodities are completely different. And similarly, companies, the jurisdictions that their subsidiaries are in tell you something about their tax minimization strategies. Lots can be gleaned from that, but ultimately it's going to take audits. And if you look at the CRA, over the past 5 years, Cameco is not the only example. There's a silver mining company called Silver Wheaton that had their subsidiary in the Cayman Islands and argued, apparently with a straight face, that all of the revenue that their project generated was actually staying in the Cayman Islands, even though most of it came back into Canada. So they didn't pay any tax on it at all. Government's going after them for more than $1 billion in unpaid tax as well. So the corporate structure can tell us something. And finally, the third point, and this is the one that I'll leave you with, anticipating revenue risks. So many of you are familiar with the extractive sector and the kind of social and environmental dimensions of the project. And in Canada and internationally, there's a very well-established set of protocols and methodologies for anticipating environmental and social risk, putting in place monitoring and mitigation measures in order to address it. But there's no equivalent on the revenue side. And if my claims at the start of this presentation are valid, that the real prize is taxes, that if you're not getting a fair share of the revenue from the sale of your non-renewable resources, then in many respects the project is failing the NWT. Why shouldn't we be anticipating those revenue risks and putting mitigation strategies in place in advance rather than waiting and potentially catching them in an audit? In many cases, unfortunately, the audits don't catch them at all, and it's just revenue lost. But my argument in the jurisdictions and the countries that I work with, we're using the risk assessment methodology that I've laid out today, obviously in a much more sophisticated and multidimensional way. We go through a checklist of about 150 risks, not the short list that I've given you here. And we try to anticipate those risks. And let me just give you one example. I've talked about debt financing a few times over the course of the evening. So rather than have a company lend to itself at 8.9%, everyone knows that intra-firm lending happens. Have the conversation before they start and come up with an agreement on what would a commercially reasonable rate be. And if you do your homework and you know that the company's raising money at 1.9% in Delaware, nobody around the table is going to agree to 8.9. So I've tried over the last 40 minutes or so to lay out a framework for thinking about revenue risks. I've tried to show you that it's really hard work to get a fair share. That to get a fair share, you have to negotiate a good deal and then you have to protect the tax base. Jurisdictions around the world that are very sophisticated, that have world-class people, struggle to do it. It's not a surprise that the NWT struggles as well. Unfortunately, there are many ways to lose $1 billion, but I think that by pooling this kind of knowledge, there are ways to close off some of those doors and make sure that the citizens of the NWT get at least a fairer share. And I thank you very much for your time.
So at least I'm part of an organization that's been saying that the resource revenue in the NWT is too low for about 15 years. And we keep getting told, well, if we make it any higher, we'll lose all the companies that won't come here. And you sort of dealt with that very quickly. I wonder if you have any more thoughts on it.
That's a really good question, and it is a hard one because you are trying to balance off inward investment and securing revenues. But the graphic that I showed at the start, that's not a before cost assessment. That's an after cost assessment. So even though costs can be high in the north, costs are high in many places. In most jurisdictions where we work, mines don't come in geographically convenient places. So I think that there's no question that the NWT and Canada generally can ask for a higher share and get it. It's the attractiveness of the resource ultimately that determines where people go. And of course, you can't be prohibitively expensive. You can't ask for an unreasonable amount. And one of the challenges that I have in some of the jurisdictions that I work is that some of the organizations I work with, and sometimes that's parliamentarians or civil society groups, sometimes want to keep asking for more and more. They never think they've got a good deal. In fact, I'll be in the Dominican Republic in just a couple of weeks presenting the analysis that I've just shown you, the kind of high-level conclusions. Many of them think they're getting ripped off, and they're not. So there's a balance to be struck, but I think the benchmarking very clearly shows that that Canada generally and the NWT specifically are asking for too little.
Okay, so are there any online questions?
Nothing online.
Any other questions for Dr. Hubert? Yes.
I wonder, Dr. Hubert, if you could speak to the international prevalence and the need for adequate abandonment and remediation security regimes as a method of risk avoidance.
That's a really great question, and unfortunately the answer is that I can't really in any great detail. It's an area that we're starting to do more work in. The area we're particularly concerned about is that companies sell assets to small companies that can't cover environmental costs. And so obviously ensuring that rehabilitation bonds are in place and the rest is absolutely crucial. But it's, I would say, the kind of secondary dynamic to the revenue risk issues, and we haven't done much work in that area yet. So, yeah, important to be sure, but not one that I can comment on in detail.
Yeah, hi, my name's Andrew. I'm just interested in you were talking about volumes and value of the commodity, and we're doing a lot of diamonds now. Have you got any stories or wisdom about how does a company report its volumes and value of diamonds? Because they're relatively small, it's easy to, the value of a diamond is fairly judgmental.
Yeah, you're exactly right. It is one of the real risk areas. Gemstones generally tend to be among the hardest to value. I mean, the stories are legion, of course. I mean, I've done a lot of work on diamonds in various parts of Africa, and the examples of undervaluation on export are all over the place. It's particularly tough where diamonds are alluvial, where they're dug up out of riverbeds rather than kimberlite like you have in the north. So by working with industrial mining companies, the odds of oversight are much better, much easier to put in place controls and the rest. A second point to be made would be that it's always best if companies are selling to an arm's length company, in the phrase, a non-affiliated company, because then you can kind of trust the market price that, if you've got a buyer and a seller in an open market, the price should be somewhere close to fair. The risk comes where companies sell to themselves. And that's a particularly high risk when you're selling something, as you indicated, like particularly gem quality diamonds, where the value is very much subjective. The challenge, of course, is that you can spend a huge amount of money in hiring professional valuation, and it can use up a lot of the revenue. I think in the case of Sierra Leone, for example, they were spending about 2/3 of their entire royalty revenue on hiring valuators to try to give them a fair valuation. So the place I would come back to here is risk-based auditing. You don't assess every package and the rest, but you have processes in place based on experts, usually outside consultants working for government, who do spot checks and who do some valuation and who test to make sure that company self-reporting is accurate. That's kind of the underlying principle here. Companies report their own production and their own taxes. And that's a legitimate approach, but it does need monitoring and spot checks and some kind of oversight.
Is there any other questions? Yes.
My name is Dawn Guinness. I'm retired, and I have a question about how do you speak to the loss of some of our natural resources that were there prior to resource extraction and have since dwindled and may not come back. So there's, how do you assess the costs of that loss in and of itself? And then how do you assess the costs as well to the people who harvested, let's say caribou? So you assess the loss of the caribou, they're no longer around, they may not return, and what's the impact on the people who used to hunt them, are still trying to hunt them, wish to hunt them in the future?
Yeah, that's a really hard question. It's a really important one, though, because it takes us back to the kind of larger cost-benefit analysis. So we know that there is an environmental and a social cost to resource extraction. You can't do it without costs. We can try to minimize those costs, but they'll always be there. And I and my company, we're not specialists in that side of the equation. We certainly don't underestimate the value of that work. We think that it needs to be done. We also believe that there are some methodologies in place, environmental and social impact assessments and the monitoring that goes along with it. I'm sure more could be done in those areas, but our strong belief is that the big problem facing most countries is that they don't generate the benefits that they should to offset those harms, however great or small those harms are. And so we're very much focused on the cost-benefit analysis. But our emphasis is on maximizing the benefits for current and future generations to complement work that's being done to minimize harms.
All right.
Thanks for your presentation. Can you talk a little bit about sovereign wealth or heritage funds as a way to provide some kind of intergenerational equity? Thank you.
Yeah, that's a great question. So the first thing to be said about those funds is that you've got to be generating a fair bit of money in the first place in order to make intergenerational funds worthwhile. Some places where I work, this is always a topic of conversation, but some places where I work, a lot of effort's gone into talking about resource management and wealth management, and there's really no wealth to manage. So that's point number one. You got to be generating a fair bit of money in order to make it really worthwhile. It can be really important for multiple reasons, not only intergenerational equity and kind of spreading the revenues over time. It can also be important for managing large inflows when there isn't the absorptive capacity to spend that money well. And that happens in many places where windfall profits come in. East Timor is a country where we do some work in Asia. And at the peak of oil prices and oil production, they were putting, they're a country of, I think, about 2 million people. They were putting $400 million US into their sovereign wealth fund every month. Every month. So in those kinds of cases, it's absolutely necessary. And then there are all kinds of questions about what are the rules for putting money in and what are the rules for taking money out. And I have not done detailed work on the Alberta case, but I know that in cases, in periods where the economy was doing well, the government was still drawing down on their fund. So there's a lot of politics around the management of them. And I guess the last thing I would say is that it's an investment in future generations to solve social and economic problems now as well. So sometimes we talk about intergenerational equity as if it's about saving money for the future. And that certainly can be part of it. But in many cases, like the Botswana example, getting good health and education and building up people's skills so that they can participate in other kinds of economic activity is as much an investment in the future as saving money.
I believe we have time for one more question.
On the first or second slide, you talked about the infrastructure. Here in our territory, it's pretty remote. We've had a power line up to mines that didn't really go very far. We've just finished a road that, more or less supported the oil industry, and we're looking at 2 other roads for this, predominantly mining-related events. Have you been doing work that looks at these sort of speculative investments in the infrastructure and the rate of return, the expected return, what benefits the rest of civil society should get out of that?
That's a really good question. The kinds of incentives that governments offer. And I've been looking for years for retrospective analyses that look back into the past and ask the question, were those investment incentives worthwhile? Did the government ultimately benefit? And of course, it's easy to look at the number of jobs that were produced and stuff. The revenues are much harder. And looking at the true costs of those incentives, and this goes across all of the kinds of tax breaks that are offered, is really very difficult. And I've been asking some colleagues about this, and they tell me that no one's got an incentive in looking back at those kinds of issues. No one that's got access to the data actually really wants to know the answers, because in many cases, the answers aren't good. In many cases, governments have provided subsidies and built infrastructure that ultimately didn't pay the kinds of dividends that they expected. I'm not a specialist on infrastructure. I know that the dual use argument and that the spin-off benefits is very much subject to challenge. Again, much of my work happens in Africa, and the best study on strengthening infrastructure in Africa, a continent that has lots of oil, gas, and mining, doesn't mention oil and gas and mining once. So as a way to generate infrastructure, I think a high degree of skepticism is warranted. And I think that, actually, to take a slightly different tack on your question, a lot of the work that we do is based on economic models. And of course, it's those same economic models that would look at whether these kinds of investment incentives and building of infrastructure were going to pay dividends. And I think the economic benefit analyses need to be looked at with a great deal of caution, because it's very easy to make sweeping assumptions about what kind of benefits there will ultimately be. And in most cases, those don't seem to turn out to be true. So I don't have a simple answer, and I don't think there is a simple answer. You need to look at them project by project. But I think the legacy of many examples suggests that we should ask much harder questions about the actual benefits. And I know that's particularly difficult in places like the Canadian North, where sometimes, particularly in economic downturns, it's a real struggle to get investment, to get new economic activity going. But just because times can be tough doesn't mean that we shouldn't be tough in our economic analysis as well.
Thank you, Dr. Hubert. So you've given us a lot to think about and much to consider. I'd like to thank you for presenting this evening. I'd like to thank